So, good morning, good afternoon, good evening, whatever you guys are watching me from. So, today somebody asked me a question about, because in my videos, most of the time, I use the term imbalance, or yeah, if I'm plotting my analysis on TradingView, I use market gap. So, I'm just going to try and explain what a market imbalance or market gap means. I'll try to be as simple as I can, using a very simple language for me to make it easy to understand. So, what is a market imbalance? Because I use smart money trading strategy, I'll try to explain as per my trading strategy. So, a market imbalance occurs when there is too much pressure from one side. So we all know that the price in the forex market is determined by forces of demand and supply. And when I say forces of demand and supply, I mean the buyers and the sellers. So where price is headed to is determined whether at that particular point of time, do we have a lot of sellers in the market, or do we have a lot of buyers in the market, or are the two forces, do you have the same equal amount of people selling and the same amount of people buying? So for me to come back on the charts, I'll try to highlight in normal circumstances how the market moves. One, we know that the market does not move in a straight line, or the market does not move in a straight line. Yeah, the way the market moves, it moves like that, comes here, goes like that, goes like that. At times it's like that for a period of time, then like that. So generally that's how the market moves. So in normal circumstances, we will have a week, 1 week like that. Let's say, assuming now this is a bearish market. So I'll try to highlight that with the red so that you see, and just increase this opacity, right? So that's how a week normally looks like. And then we'll have another week just below this, starts from here and ends here, and then we'll have another week, or candle, sorry, not weeks, not week, we'll have another candle that begins from here. Come on, yeah, that begins from here to here. So this is a normal way that the market moves, and the same will apply if we have if you're into a bullish market. So to illustrate a bullish market, moving this thing is a problem. Come on, yeah. So to illustrate a bullish market, that will be one, and then number two. Okay, I'll just draw. It's much easier to draw than to copy. So we'll have a bullish market. Number two, another one here, and then another one there. So this is a bullish market. So I'll just change the color to give it a different look. So you're in a bullish market, I'll mark that with the color blue, and same to this bullish market, bullish market, and then bullish market, or a bullish trend. So that's how price normally moves. So in normal circumstances, if you look at the market, there are times that this will have a little bit of wicks, like those tiny things you see. Yeah. Or this one will, let's say, terminate up to here, So that's how the market is supposed to move. So in a normal favorable market, this week and that week, they're supposed to close together, in that there is no any gap or space in between. See, like this. Now this is a good market. But to illustrate using the bearish market, there are times like you'll find that the market has left some gap like that. Yeah, a huge gap like this. Or if it's a week terminating, let's say if this is a bullish market, you'll find that this market had just a small wick up to there, and maybe this one terminates up to there. Yeah. So anytime, any particular point of time that you have a space in between these two, in between the candles, or in between the wicks, this is what I refer to always as a market imbalance. So anytime we have those gaps, it means that at that particular point of time, there's a specific pressure that is affecting the market. Like in normal circumstances, you will find that a market will first go what we call through manipulation, or at times they use market ranging, or at times people say market consolidation. And then after this, you find there's a big upsurge in the market like this. So in between this region here, price is consolidating. Like this is when I mention and say that we don't have this is when I mention and say that we do have equal buyers and equal sellers, because they're trying to outshine each other. The buyers push the price up to here, the sellers reverse the price. Buyers push the price, sellers reverse the price, buyers. So like that. So, but then after that, there's a huge move. So when there's this huge move, because it's only one dominant force that is in the market, this is how it ends up leaving the market gaps or market imbalances. So that's one. Number two, I've already said how these imbalances are caused. They're caused about one, by having a dominant force in the market. What are these things that make this a force to be dominant in the market? One, it can be during economic news, like you have news that are affecting a particular currency, or you can have news that are going to affect a particular pair. When you have such news, it's when the price will move in one direction or surge in one direction. Number two, you might find that at times when the market has a break, by what I mean the market has a break, it means, like, for example, on a weekend, when, let's say, by Friday, price ended here, yeah, at this level. This is where price ended. But because in some markets, there are some other economic activities that continue happening, even if when the market is on the break, like between Friday and Monday, sorry. By the time the market comes back, so assuming the price ended here when the market ended here when price, let's say, was 10.5, right? And then when we come back on Monday, we find that the market began down away from here. Let's say this will be 8.5. Because when the market comes back, it will not begin from where it left on Monday. Price will have moved a little bit, leaving a huge gap. So that's what we call market gap or market imbalance. So those are among some of the things that cause imbalance. Now there are two types of imbalances. One, we have this what we call a breakaway imbalance. This one, the one that I've highlighted here. This is what we call a breakaway imbalance. So just to right here, we call it breakaway imbalance. Breakaway imbalance. Yeah, where is it? I thought I wrote it here. So where's the text? Put on top. So yeah. So this is what we call a breakaway imbalance. Like price has consolidated after some time, it surges on one direction. Then this other one here, this is what we call common imbalance. This one, where because of maybe news or other economic issues that affect the market, that the market will leave a gap as it goes down. So those are the two types of imbalances on the forex market. So most of the time when you hear me say the market left an imbalance or the market left a gap, that is what I mean by imbalance. Now I want us to have a quick look at how it appears on the charts. So I'll just clear this, clear that, and just play it on the real chart and see how the market moves on the chart. Okay, so you have noticed this is NAS 100. You have noticed one thing, that The market, while it was on the move, because the way it started by consolidating. By consolidating, it means this is where the market makers were manipulating the market. So this was consolidating. When after the market consolidated, it made an upside move. See, this is an upside move, and we have called this. This is a breakaway. This is a breakaway market gap. Now, remember, when they were pushing the price to the downside, they left this gap here. The market price left that gap here. So this is what, in most situations, or normally, I highlight it as a market gap or a market imbalance. I hope up to there you have understood. But now, this is the funny thing, that market imbalances or market gaps, the market makers will always come to fill the market, the imbalances. They will never leave this. They will always come to fill the market. Now, I'm going to play this and just to show you how the market came to fill this market imbalance. And you will see that when the market creates an imbalance, it has to definitely come and fill it up. So I'll just replay. Do you want to exit this chart to replay? No. Let's say yes. All right. Oh, I've lost it. Oh, I was here. Sorry. So let me just go back. So we were here. Uh, we were here. Okay. Come on. So we were here. Okay. Replay. Oh, why is it not playing? Anyway, I'll just illustrate them. So if you want to see how how the market filled that imbalance, so we are here. How the market did fill this imbalance, they brought the price all the way up to down here, consolidated the price for a few minutes, for a few that's a few hours, then pushed the price up back and corrected this imbalance here. I'm going to highlight another, I'm going to show you another imbalance and how they filled the imbalance. So I'll just clone this, clone that, and another imbalance is here. Same way they brought the price down, came back and filled the imbalance. Another imbalance that I'll show you, there's another imbalance here. Same way, there was a gap. They came back, filled this position, and continued and brought the price up. Another huge imbalance like this is the best way to illustrate it. There was that imbalance that the market created when it was pushing price up. There's one, then let's clone this, and then there's two. Now let us see how the market makers manipulated this to how they filled this huge imbalance. So most definitely, if they created the imbalance while moving the price up, definitely the market will come back to correct this imbalance. Now, if you move forward, let's move forward a little bit, see how they did. They brought the price up, price went all the way up, brought price back down, and cleared the first imbalance. You see? We cleared the first imbalance. When we continue ahead, you find that the market came back and cleared the second imbalance. And while, because here, this is the second imbalance, so they brought the price all the way up to here to clear that imbalance. And while doing that, they also made another imbalance on top here, when they're bringing the price down to clear that imbalance. If we continue going forward, we'll find that this imbalance was cleared at some time, or it hasn't yet been cleared, but they have cleared half of it. As per now, they have cleared half the imbalance. So if you are right now trading this this pair, most definitely, they will move price upwards to clear this imbalance. But then, if you are very keen, you also notice that still, as they're moving price up, they are leaving some more imbalances downwards. And to be very honest with you, there are people who use imbalance as a trading strategy, in that when you are trading an imbalance, let me just use this level to highlight more where there's that big imbalance. So when you're trading when you're using a market gap or trade imbalance as a strategy, it just means that you are keen to see how the market moves from one imbalance to another. Yeah. So like a person who had left an imbalance, who saw this imbalance, will wait and wait and wait and wait, knowing that at some level or at some specific time, the market will come back to clear this imbalance. So that person might, for example, enter into a sell when price is here. You see, when that person enters a sell when price is here, he holds the trade all the way until when this level is cleared or when the second imbalance is cleared. And if you are to count how many bars, that will be on a 30 minutes time frame until when this was cleared, you'll get that those were around 179 bars. And if you're to look at how many pips this would have been, if someone entered, let's say from here up to there, that is around 450 pips. So I hope this explains it, how the market makers make the imbalances. And maybe just to recap, now that you're finishing, just to recap, I'll just try to write here that number one, um, what are market gaps or imbalances? That's what we've looked at today. Yeah. Number two, we have looked at how they are formed. They are formed. You have said that they are formed when there's pressure of the market to one side, or when there is economic news, or when the market is in a break. And number three, what causes them. And number four, how to trade imbalances. But this number four, I'll do another video to get into in-depth detail on how you can use the trade imbalance as a strategy. But as for me, I don't use it as a strategy. I just use it. I use trade imbalances as my confirmation on where the money is, or where the market makers have left the money. So I'll know that if there's an imbalance here, most definitely they will bring back the price to cover or to correct that move, because an imbalance is just like in a normal life situation, how life has given balance. Where there's light, there must be darkness. There's day and night. There's crying and laughing. So the market also does the same thing to us. Anyway, that's it for today, and I wish you a lovely trading week, and I hope I made sense. Feel free to ask any questions as much as you can, and like my video, please. Thank you, and bye-bye.